So you're staring at a stock ticker, right? And you see that number just constantly flickering up and down, second by second. You might honestly assume there's some secret group of Wall Street big shots in fancy suits sitting in a closed room pulling the strings and setting that price. Well, I'm here to tell you that is a total myth. In this explainer, we're going to demystify stock prices once and for all. We'll break down the mechanical reality of trading versus the actual foundational value of a company, so you know exactly what's happening behind those flashing numbers. Okay, so here's our roadmap for the explainer today. We're going to kick things off with the order book battle. Then we'll move into what is intrinsic value. From there, we'll look at 4 ways to value stocks, contrast value investing versus market hype, and finally, wrap it up with the limits of valuation. Let's dive in.
Section 1. The Order Book Battle, the Mechanics of Stock Pricing.
So, who really sets stock prices? Well, at its absolute core, the stock market is just a massive, completely chaotic marketplace. It's not some quiet boardroom, it's literally just buyers on one side, sellers on the other, haggling over prices in real time. You know, when you see a stock price pop up on your app, that's usually just the price of the very last transaction that happened. But it absolutely does not mean that's the exact price you'd get if you tried to trade right at this very split second. To really get this, you gotta think of the order book as the market's secret playbook. It's a live, constantly updating list showing exactly what buyers are currently willing to pay, which we call the bids, and what sellers are willing to accept, which are the asks. This right here is the true pulse of the market. And right there in the middle, between those bids and asks, that's where the actual magic happens. That's where a buyer and a seller finally cross paths, agree, and make a deal. Think about the psychology here. On one side, when you have hyped up, aggressive buyers practically begging for shares, they'll throw out higher and higher bids, right? It's like a frantic bidding war at an auction, and that pushes the stock price up. But on the flip side, if some bad news drops, scared sellers start to panic. They constantly lower their asking prices just to find any willing buyer. It becomes this massive clearance sale that drives the price down, and fast.
Section 2. What is intrinsic value, the foundation of pricing?
So we've seen the chaotic mechanics, but what about the actual foundation? That brings us to intrinsic value. This is basically the real foundational value of a company based on its actual concrete fundamentals. We're talking about tangible things here, its earnings, its physical assets, and its real growth potential. Basically, it's what a company should genuinely be worth if you could just hit mute on all the hype, all the panic, and all the aggressive finance bros on Twitter. But here is the real kicker, and it's super important. Intrinsic value is not some objective reality. It's not a magic number that everyone universally agrees on, like weighing a bag of apples where everyone's scale gives the exact same result. It's really not like that at all. Instead, it's a subjective estimate. It's much more like guessing how much those apples are going to sell for next year. Investors use this estimate to try and figure out if a stock is currently undervalued, meaning it's a good deal, or if it's overvalued, and maybe they should just wait.
Section 3. 4 ways to value stocks, calculating the foundation.
Since every company is fundamentally totally different, smart investors don't rely on just one magic formula. They actually have a toolkit of 4 primary valuation methods. First up is discounted cash flow, or DCF. This focuses on future cash profit, and it's really the heavy lifter for most standard companies. Second, we have the dividend discount model. This one looks purely at shareholder payouts, making it perfect for those established utility companies that pay super reliable dividends. Third is asset-based valuation. You literally just take a company's physical assets minus its debts. It works wonderfully for real estate firms or traditional banks. And finally, earnings multiples, like the famous PE ratio. This focuses on comparing a company's profit per share directly to its industry peers. It's a much quicker method, super popular for analyzing rapidly shifting tech companies. Now, I know things like discounted cash flow sound incredibly intimidating, so let's completely bypass the complicated financial jargon and break it down into 3 incredibly simple steps. Step 1, you just predict the future cash profit after expenses that a company is going to generate over the next few years. Step 2, you discount that money back to today's dollars. Why? Because future money is simply worth less due to realities like inflation. And step 3, you add in the terminal value, which is really just your best estimate of what the whole company will be worth after your detailed year-by-year forecast ends. That's the whole shebang. Let's actually put a real number to this to make it crystal clear. Let's say you do all that math, right? And the total calculated intrinsic value for a company comes out to exactly $1,000 today. Well, if that company has 100 shares out there, that equals exactly $10 per share. What does this mean for you? It means if you look at the real-time market and the stock is trading at $8, it's an absolute steal. It is undervalued. But if it's trading at $12, it's overvalued, and you might want to hold off on buying.
Section 4. Value investing versus market hype, the human psychology.
Now, some investors out there swear entirely by intrinsic value. These are your hardcore value investors. Warren Buffett is pretty much the ultimate example of this. He has this famous quote that hits the nail on the head. He says, "Investing is like buying a farm. You look at its soil and crops, not what the neighbor paid yesterday." Think about that. Buffett buys stable companies when they're trading below their calculated intrinsic value, and he just holds them long term. He completely ignores the daily, chaotic ups and downs of the market.
And this creates a really fascinating clash in human psychology. On one hand, you have Buffett's super grounded strategy of value investing, right? Buying established, somewhat boring but stable companies like Coca-Cola or Walmart, where the earnings and assets are entirely clear based on today's tangible profits. But contrast that with market hype. Think about a stock like Tesla a few years back. People were not buying it for that day's profits, no way. They were eagerly buying the dream, the expected future growth, the world-changing technology. And all that excitement pushed the price way, way above its fundamental baseline numbers.
Section 5. The limits of valuation. Why prices deviate.
So why exactly does a stock's mechanical price sometimes just completely detach from its intrinsic value? Well, there are three main culprits. First, market sentiment. When investors get overly excited about a new industry, they just bid up prices like crazy and ignore fundamentals entirely. Second, future expectations. Investors in growth stocks, especially in tech or biotech, are often totally willing to pay a massive premium today just to bet on wild profits years down the line. And third, external factors. A really great historical example is the period of rock-bottom interest rates from 2020 to 2022. That environment made stocks just generally much more attractive to hold than bonds, and it aggressively drove prices up across the board, completely regardless of any single company's underlying base value.
Before we wrap up, it is absolutely vital to remember that intrinsic value is, at the end of the day, just an estimate. It relies on guesses about the future, like upcoming economic conditions or growth rates, and those guesses can be entirely 100% wrong. For highly unprofitable startups or, say, biotech firms waiting on one massive breakthrough, calculating intrinsic value can actually feel pretty useless because the future is just so hard to pin down. This means you absolutely must always do your own research or, better yet, talk to a certified financial advisor. Investing has very real risks, and you could lose your money.
So, to wrap up this explainer, I want to leave you with a bit of a provocative question to chew on. If intrinsic value is ultimately just a subjective guess about the future, and the mechanical order book is constantly driven by the wild, unpredictable emotions of hyped buyers and panicked sellers, what are you really buying when you purchase a share of stock? Keep that in the back of your mind the next time you see those red and green numbers battling it out on your screen. Thanks so much for diving into this explainer with me, and keep exploring.